Good morning. It's Jeffrey Christian of CPM Group. It's just about 11 o'clock here in New York on Friday, the 13th of December. I want to talk today about precious metals prices, the recent data that we've gotten on the United States consumer and producer price inflation indices, and the effects on interest rates of the inflation data, and consequently the effect of interest rates on gold. So that's pretty much what it is. At the end, after I've gone through inflation and interest rates, I'll talk a little bit about where precious metals have been in 2024 and why. And I'll give you a little bit of an outlook toward the end of the year and into 2025. I think that the name that I've applied for 2025 will be a consequential year. The name that I applied to 2024 was another year of living dangerously. I think that we have seen that as a pretty good call a year ago, and it's been reflected in higher gold and silver prices. I think next year will be a year that will be quite consequential, both in terms of consequences for past activities, including those in 2024, and also it'll be consequential in terms of what happens in 2025. I'll talk a little bit more about 2025 at the end of this presentation, including what our publication schedule is going to be. But diving into precious metals, U.S. Consumer Price Index came out this week. Headline inflation relatively flat, around 3.3% year over year. Kind of problematic in that it's sort of stalled out. That's the core inflation. Headline inflation has actually been rising for the last 2 months. Last month, it was rising primarily because of higher food costs, and a little bit confounding because you saw a sharp decline in fuel oil prices, keeping headline inflation lower than the core inflation. But even with that sharp decline, I think it was about 18% or 19% in fuel oil prices, what we saw was a continued increase in the headline data, primarily because of food. There. We tend to look at month over month because that tells you what's actually happening from month to month as opposed to year over year. And what we saw was that after 4 months of 0.2% monthly increases, we saw a 0.3% increase, highest level since April. A little bit problematic and a little bit worrisome. If you look at what we're seeing, headline inflation, 0.3%, 2.7% for headlines year over year. The core was 0.3% and 3.3% year over year. So in the headline inflation, which is rising, and the core remains relatively high, in the core goods, we saw a 0.6% decline in core goods, but core services rose 4.6%. This has been the pattern for some time now. Most of the inflationary pressures in goods, whether it's used cars, new cars, clothing, non-food, non-energy goods, has actually been relatively low. And in the case of November, we actually saw a decline. But the services costs, especially transportation, medical, and shelter, rent and or monthly payments on homes through mortgages, includes utilities and taxes, have been rising. So the inflationary pressures remain on the service side, and the goods provision has been relatively low, ex food and energy. Now, looking at the PPI, relatively flat. Headline producer price inflation was 0.4%. The core was 0.1%. That's pretty healthy month over month. So we're seeing that again, the core is relatively under control, but the food and energy costs have been higher. You had a good price inflation of 0.7% due to a 3.1% spike in food prices on a wholesale level. The core was 0.2%. Services were 0.02%, with transportation down 0.5%, and trade actually up 0.8%. All of that factors into inflation, interest rates. Now, we will be traveling next week, a couple of us, and so we may not have a video on Tuesday, but on the 17th and 18th, Tuesday and Wednesday, you will have a Federal Reserve Bank's Open Market Committee meeting, and on the 18th, you'll see an announcement and some information from the FOMC on what it sees in terms of inflation. The markets are still betting 19-1 that the FOMC will reduce the target Fed funds rate by 25 basis points on the 18th of December. The inflation, yeah, headline inflation being stronger, this is good for gold in the medium to longer term because there are investors who buy gold as a hedge against inflation. On a shorter term basis, it may not be so good for gold prices because it may cause the Fed to pause its interest rate cutting program, which it began earlier this year, because the inflation indicator are relatively stronger. Again, the markets are betting the Fed does cut rates. We're not going to bet against those kinds of odds. Given the relatively stronger economic data and some signs that inflation across various segments of the economy are not declining at what the Fed or others would call acceptable rates, the potential is there for a pause in interest rate cutting policies and efforts by the Fed. Probably not on the 18th of December, but possibly in the first quarter of 2025. It depends on what happens with the data between now and January, February, March of next year, because the Fed does actually look at the economic data and make its decision based on what it sees as the state of the U.S. economy. We think there's a low probability of a pause in the Fed's interest rate policies right now for two reasons. One is less important, and that is that interest rates have been being reduced by central banks around the world. So the trend is there. The second one, which is probably much more important, is the Fed is fully aware of the tremendous nervousness and uncertainty in the U.S. consumer and business communities about the political, economic, and financial disruptions that are hanging over the U.S. economy. There's a tremendous amount of uncertainty, and there's a tremendous amount of nervousness about that. And that is probably causing a pause in business investment in new plants and equipment and hiring, and a pause or more caution on the part of consumers. So you put all that together, and the Fed has a tough decision to make, not only next week, but going forward. These are the target rates that the Fed sets for the Fed funds rates, and you can see, they did rise from virtually 25 basis points earlier this year to about 5.25 basis points. They come off since September or so, and they might come off a little bit more. We don't see interest rates going back to 25, 50 basis points, nor do we see them going to 10%. So we're looking for some decline in interest rates over the course of next year, maybe moderate. if we go into a recession and if this recession is severe and if the consequences of political changes in the United States and on a global basis are particularly hostile for economic growth, we could see greater reductions in interest rates and higher gold prices. And if the economic environment remains relatively strong, we might not see a reduction, reductions in interest rates by the Fed, and gold prices would probably remain high because the amount of nervousness and uncertainty will continue and probably will grow. The higher stock prices get, the more nervous investors who have money in the stock market become. And you've got record high, or you had record high stock prices last week. You're at or close to record high stock prices, and there are any number of Jeremiahs out there saying, "Hey, this thing's going to fall 20%, 40%, 100%." So that creates a nervousness on the part of investors. This is what gold and silver, platinum, and palladium did over the year. At the end of last year, the last trading day settlement price for gold was $2,071. 2 days ago, it was $2,685. That's a 30% increase on a daily settlement basis. So we've seen a pretty strong rise in gold prices, predicated primarily on that investor uncertainty and nervousness that we've seen over the course of the year. Another year of living dangerously. Silver prices rose even more, from $24 an ounce at the end of last year, to $32 2 days ago. That's a 34% increase. Now, prices have fallen yesterday and today, but if you look, prices have fallen across commodities and across asset markets, including the stock market yesterday, because of that investor nervousness and uncertainty. Will the Fed pause based on the stronger inflationary data that we're seeing and indications that we're seeing this week? While gold and silver rose sharply in 2024, platinum and palladium fell significantly. Platinum was off 4% from $995 to $950, and palladium went from $1,100 to about $1,000, $996. So a 4% decline in platinum prices, 10% decline in palladium prices. That reflects investor concerns. Well, it reflects lower fabrication demand in the auto sector because of the ongoing shift to electric vehicles, which now represent about 14% of the market, half of which is in China. That is reducing marginally the amount of platinum and palladium and rhodium being used in the auto industry, which is the major use for these metals. And it also reflects investor concerns about that loss of auto market share. And that's probably going to continue. Again, I've already talked about it. The gold prices have risen pretty steadily since the second quarter of this year. We have seen prices come off a little bit over the last couple of days. CPM Group still expects prices to rise further possibly yet in December, but definitely in the first quarter. We might see a peak in the first quarter, some weakening in gold prices in the second quarter, but then probably higher prices in the second half of the year because we're looking at a much more hostile political and economic environment, regardless of how things shake out. Silver prices have kind of followed gold. As I said, surprisingly, silver prices have outperformed gold in terms of point to point last day of 2023, trading day of 2023 to Wednesday of this week. But they have come off somewhat, and on an annual average or a quarterly average basis, silver prices have kind of not kept up with gold in terms of investor attitudes. There continues to be a heavy two-way trade on the part of retail investors. You have some retail investors who continue to buy silver, but we have seen a lot of silver profit taking, which is now backing up in the dealer market and at silver refineries, where a lot of the silver is not necessarily official coins or good delivery bars. So medallions and non-good delivery bars are being melted down, re-refined, and cast into new bars. So I said platinum and palladium. With gold and silver, I had the longer term chart back to 2019, which is when the bull markets for those two metals started. For platinum and palladium, I'm taking the longer term chart back to 2014 because that's when you had a sell off in these metals. And you can see from that longer term price chart the degree to which platinum prices have been moving sideways really for a decade now. And on a shorter term basis, you can see that while the price has tried to rise above $1,000 a couple times over the course of this year, um, it keeps falling back and moving down toward that $900 support level. Palladium prices, again, on a long term basis, you can see how they rose very sharply from 2016 to 2022, and then they've come off since that time. And this year, they basically have been moving sideways. They did make a run at 1250 at the end of October, along with a lot of other commodities, but they came off very quickly. And you've seen some very large moves on a daily basis in palladium starting in the middle of October. We're coming up with our outlook, our schedule for our gold yearbook, our silver yearbook, and our platinum yearbook. These are the dates where we will be launching them with free online briefings, and they will be releasing the actual reports that investors can buy or anybody can buy at our website, cpmgroup.com. You may pre-order them as well. We'll come out with our gold report in late March, which is where we've been doing it since probably around 2002. And silver will come out in late May, and PGM yearbook in July. You can get our shorter term views with our precious metals advisory or our retail investment program. These books have the historic data and projections for supply and demand in 2025. They'll have. In late February, we will do our Silver Facts and Fantasy webinar again in advance of the Canadian Prospectors Development Association of Canada conference in Toronto, and we will have our silver reception on that Sunday, March 2nd. We're also in the planning stages for a silver seminar, tentatively in Boston, tentatively in late October. And we're speaking to a number of groups about participating in it. We want to make it a event that focuses on the real silver market as opposed to some of the facts or the fantasy silver market, if you will, that has become so prominent since 2021. You may or may not see a video from us next Tuesday. As I said, we will be traveling. If we have time, we may do a video. Regardless of that, we'll have our final video for 2024 next Friday, the 20th of December. And we'll be sort of going over in perhaps a little bit greater detail some of the developments in gold and silver and platinum and palladium in terms of fabrication demand, total supply, secondary supply, central bank gold purchases, and other more fundamental factors. Our first video of 2025 is likely to be Friday, the 3rd of January. We may wait until the following Tuesday to do that, and we'll talk more seriously then and in more detail about how we think that 2025 will be a very consequential year, politically, economically, and in terms of the market outlooks for gold, silver, platinum, and palladium. That's all I have right now. You can go to our website, cpmgroup.com, order our yearbooks, get a lot of other free reads and videos that are there. You can send us an email at info@cpmgroup.com and say, CPM Group, let's talk about how you can help me manage my exposure to precious metals and commodities more effectively. In the meantime, take care of yourself, take care of each other and those around you, and see if you can do something good for the world as we head toward wrapping up this year. Take care.